America's white-hot jobs engine is starting to slow down. The government says the economy added just 20,000 jobs in February. That's the weakest in 17 months. Investors were expecting a gain of 180,000 jobs. The unemployment rate fell to 3.8%, its lowest level in nearly half a century. Here's how Wall Street is reacting, and you can imagine not pretty well. Dow futures off 200 points right now. We've got S&P futures down by 20. NASDAQ futures sinking 64 points. Yahoo Finance's Jessica Smith has more from Washington. I guess one bright spot, Jessica, wages were up in February.
Right, the average hourly earnings stand at $27.66. That is up 11 cents from February, and it's a 3.4% increase year over year. That's a bigger change than some had expected. The expectation was for a 3.3% increase year over year. We did also have some upward revisions for December and January. The Labor Department says the economy added 311,000 jobs in January. That's up from the 304,000 originally reported. Job gains in December were revised to 227,000 from 222,000. But again, the big numbers, as you mentioned here, the U.S. economy adding just 20,000 jobs in February, far less than expectations, and the unemployment rate ticked down to 3.8%.
Okay, what about the participation rate? Any signs that Americans were coming off the sidelines and looking for work?
Right, the participation rate in February held at 63.2%, so staying about the same there. We did see some gains in professional and business services and in healthcare and trade. If you look at the specific industries here, construction did see a decline. The construction industry lost 31,000 jobs in February. And we should note the government shutdown is playing into this as well. The Labor Department says the number of people unemployed decreased by 300,000 in February. So as people who were temporarily laid off, who are not working because of the government shutdown, went back to work last month.
All right, Jessica Smith, thank you. Now, to help break down the numbers a little more for us, I am joined now by Omar Sharif, the senior U.S. economist at Societe Generale, and Kristina Hooper, Invesco's chief global market strategist. Good morning to you both.
Good morning.
On the face of it, this number seems pretty alarming, but I'll start with you, Omar. Are you alarmed?
Not yet. Granted, obviously, it was way below expectations, but I think we've got to kind of keep things in perspective. We had a big blowout jobs number in January, well over 300,000. And it's important to point out that was not revised down like the initial December print was. In fact, jobs were added back to both December and January. The three-month average is sitting around 185 right now, even after today's sort of disappointing number. But, I think job growth is still holding in quite well. I don't want to sort of overreact to one print. But as you mentioned, wages are up 3.4%, new cycle high. The upward revisions to job growth, I think, also help. So for me, yes, it's certainly kind of caught everyone's attention, but there are still some good elements to the report. Three-month average still looks pretty decent, so I wouldn't get too alarmed about this.
Do you think that this was a one-off, a bit of an anomaly?
I would expect so. However, we have to look at it in the context of what we've heard from central banks. We've seen this really significant reversal in stance by the Fed first, then the Bank of Canada, and just yesterday the ECB. And so looking at the jobs report in that context, I think may raise alarms.
Now, they were also talking about weather perhaps skewing this report, right?
Right. So we had about 390,000 people who were not counted as employee, who didn't go to work at all because of the weather. So typically for February, you get around 300,000 or so. That's sort of the 20-year average. So we punched a little bit above that in this particular report. So you're probably talking somewhere around 80 to 100,000 potentially in terms of the number of people who weren't counted as employed because of the weather. So that's another reason to sort of, discount this a little bit to some extent and think about next month.
I want to talk more about wages because we know the Fed really hones in on that. We saw wages rise 3.4% year over year. Do you think that's enough, Kristina, to change or to move the needle at all for the Fed when it comes to inflation and raising rates?
I don't think just yet. The Fed wants to be dovish, and so they're going to look for reasons to be dovish. But if we start to see a continuation and an acceleration in wage growth, coupled with increases in input costs, the Fed may have no alternative than really getting more hawkish.
Would you agree with that?
Yeah, I think that's correct. In fact, if anything, what we've seen is Chair Powell talk about the fact that wage growth doesn't necessarily have to lead to higher inflation in terms of the CPI and their preferred metrics of the PCE. We can still see wage growth pick up because they're really honing in on the participation rate. They think there's more slack in the labor market so that if we run the economy hot, we can bring more people in without really stoking inflation. So that's been a key focus of theirs in the last several months.
Let's talk about participation rate flat, didn't move, 63.2%. Is that odd for you to see that not move given the strong economy that we have and labor market?
Well, we've had a nice move over the last 12 months. We've gone from about 62.7% to the 63.2% we're at now. So I look at it in that broader context. One data point does not a story make.
Mm-hmm.
Yeah, one other thing I want to point out is, the move that we have seen over the last 4 or 5 months, we've seen these sorts of big jumps in the rate over a very short time frame before. We saw it in late 2015, early 2016. A lot of what tends to happen is because these numbers are so volatile, it's not necessarily that we're drawing in so many more workers off the sidelines. Oftentimes, it's fewer people choosing to leave the workforce altogether. Now, net participation rate still rises, but at the end of the day, that has different implications for monetary policy than if this was all just excess slack.